Hello and welcome everybody to this XTB video. My name is Walid Koudmani, Chief Market Analyst for XTB. And in this video, we're going to be covering the ongoing situation between Russia and Ukraine, the tensions on the border, what's been happening so far. We discussed this briefly in a video last week, outlining potential scenarios, which you can find on YouTube. But today we're going to be covering how the markets have reacted so far to the ongoing escalation, what the potential scenarios and what the markets may react or how they may react, what markets may react as well. We're going to be going into the background of the conflict a little bit just to discuss how it started and how it's been ongoing for several years at this point. So it's not very much something new. And we're going to close it with some final thoughts as well as to how things might develop moving forward. So let's start with the disclaimer as always. And thank you very much for being here with us. Today, we're going to discuss the origins of the conflict as well. So this started several years ago, back in 2014, after Viktor Yanukovych was overthrown. And the Ukraine was ensured its borders will not be violated after the fall of the Soviet Union. So obviously, Ukraine was one of the countries that was formed after the fall of the Soviet Union. And it was ensured that its borders would not be violated. So over the course of time, we've seen several incursions and several disputes over parts of it, and between the Russians and the Ukrainians. And part of that, and the most famous one potentially, was in 2014. Russia still wants to have influence over what is happening in the country and halt Ukraine's ambition to join NATO, which is another side narrative that has been happening as of late as well. So in addition to the resources that are there, Russia feels a little bit more intimidated by the fact that NATO would be encroaching on its borders by if Ukraine would join NATO. The Crimea Peninsula was annexed, and fights in separatist-controlled area in the eastern part of the country have been ongoing for 8 years at this point. Interestingly enough, eastern Ukraine accounts for over 20% of the country's GDP. Numerous mines and smelters are located there, while the southern part of Ukraine has wheat, corn, and sunflower fields. So you can see very rich in raw materials, very rich in production, and 20% of the GDP of the country itself. So you can see the map here by speaking language. Is it war already is a question that many have asked. The US government seems to be a little bit unsure about that as well. I think a lot of people in the media as well are unsure. So reaction in the market is based on this uncertainty, whether it is full-blown war or it is some sort of an incursion at this point. And we can see that, but based on these maps as well, Russia has been building up presence of its troops near the Ukrainian border for weeks now, claiming those are just military drills. We saw that last week. We discussed this as well with like a potential de-escalation of the conflict happening with Russian troops withdrawing. That was what they announced, although that is not exactly what happened. Speculations about potential invasion started before the Winter Olympics in China, and there were some rumors that that might occur during the Winter Olympics. That didn't really happen, but we are seeing more intensification of the conflict right now. United States informed last week that decision of invasion has been made already. Russia denied an announced troop withdrawal, which did not occur, as we discussed. Russia has been ambiguous in its demands, which they made public solutions hard to achieve. So part of it is the NATO issue, where they would not want Ukraine to join NATO because then NATO would be at their border. Another one would be potentially these controlled areas where there's a very, very high capacity for resource production and, as we saw, raw materials as well. And it's kind of ambiguous in that sense where the Western governments aren't sure exactly. Definitely investors are not sure as well. Markets eventually started to price in a potential military conflict. The more it drags out, the more it becomes priced in as well. And we can see here the border of Russia with Ukraine on the right side. These are the two places that have been so far very contested. Crimea is already gone, and we have Belarus at the top. So this is the area of contention at the moment, but it could be expanding into several other areas moving forward as well. Recognizing L.PR and DPR independence triggered market panic. So we saw this very recently. Putin's speech on Monday. Modern Ukraine was created by communist Russia. Soviet Ukraine was created by Lenin. We are ready to demonstrate what real decommunication means. And Russia has always had open relations with Ukraine. So they see it as one and the same as Russia almost. They see it as part of their country. They're still not over the Soviet Union in that sense. And they see it as something that really was part of it and is still part of it in a sense. Ukraine leaders were infested with corruption and nationalism, plans to develop its own nuclear weapons, and US drones are constantly spying Russia from Ukraine. So you can see that a lot of it is geopolitical control, a lot of it is resources, and the Russian speech, or the Putin speech, really kind of outlines that as well. What can happen next? We could see Western leaders need to decide on sanctions. We saw some of them already being implemented. although not very serious. You can find an article on the X station about that, quite in depth about these sanctions so far and what sanctions may be needed to make them pull back a little bit more. Although it's a very interesting situation because Europe is so reliant on Russian energy that any sanctions on energy, which is most or one of the most important, if not the most important sector for Russia, would then backfire on Europe in the sense that they would have extremely high energy prices and probably cripple their economy in several ways. So they have their hands tied in a certain sense, but at the same time, they are trying to de-escalate the conflict through sanctions that are really not having that impact at the moment. Russian army enters rebel-controlled regions to offer help. We saw that. So they were let in at this point, which that's the really topic of contention of whether it is an invasion or not. De-escalation looks unlikely in the short term, though, and markets have already priced in a lot. Further sell-off could be triggered by news of Russian army entering non-rebel control Ukraine territories. So in that sense, it would be, in essence, an invasion at that point, because they are entering a place where they would not be welcome, as opposed to here where, let's say, rebel-controlled areas are already welcoming them in. We have seen some reaction in key markets, so let's take a look at the charts on the X station as well. We saw the DAX, which is DE30, huge pullback on the DAX here on the daily chart. You see pulling backwards, breaking past this potential head and shoulders pattern around 1500, so key level as well, and reaching the lowest level in several months, really almost a year at this point. Yes, we see that obviously the range being broken as well. We saw US 100, which is the NASDAQ, US tech stocks, similar situation, although not quite as steep. We saw an 18% decline since the highs reached fairly recently towards the end of 2021, with an attempted rebound, testing the 50% Fibonacci retracement, and then pulling back down to around 13,735. Now, some of it has been impacted by the earnings reports. We saw some unexpected disappointments in the earnings season for Wall Street, but at the same time, and also with fears of monetary policy change, we discussed this in previous webinars, but at the same time, you can see this clear reaction here, these three last candles really, as the conflict continues to escalate. Almost 20% Fed is the main driver, as we said. Oil, on the other hand, is actually benefiting from this tension and this conflict because the energy market is so tied into the Russia-Ukraine situation, and then Europe as a consequence. Russia, as I said, provides a lot of European natural gas and oil. So any potential shortage is being seen favorably by the price at this point, which is testing around $94, $95 for Brent, and then approaching on this trend line really a potential $100 per barrel. Gold, similar situation to oil. Gold, though, being seen more as a safe haven, which it traditionally seemed to be. For a while, it really wasn't acting like that, especially during the massive rallies that we had seen in stocks, thanks to incredible, unprecedented monetary and fiscal policy. At the moment, though, we are seeing a test of around 1900, and we saw a test of 1913, 1914, and then a small pullback today. But still, gold really benefiting from this situation as well. Several month high, almost a year high at this point, and breaking past a previous range. Bonds as well, we can see the correlation or a potential correlation where as they continue to decline, gold continues to rise. And you can see that with these blue candles here on the chart overlaid. Now, the Russian index, definitely one of the worst performers because of how closely it has been impacted. Taking RTS oil correlation into account, RUS is trading around 40% discount in the sense that it's dropped about 40%, especially considering the fact that usually it would benefit from oil prices being higher because so much of it is actually based on oil and energy resources. But the sanctions, and then the other side of the coin is obviously these tensions that do not bode well for these companies that are listed. Because if some of them receive sanctions, they can't trade with the West, and then a lot of their business is gone. So traditionally, they would be potentially benefiting from a rise in oil prices. However, at the moment, it really is backfiring on the stocks. See a huge drop at the point. So how markets have performed at wartime in the past is quite important because it is not an absolute panic. Not everything goes down, not everything goes up. Really, things tend to develop as time goes on. You can see we discussed already how some things are priced in, some things are not really priced in. The more the escalation takes longer to develop, the more things get priced in at the same time. So let's take a look how in World War One, for example, we're going very far back, had a negative impact mostly on the German equities only that ended up devastated, obviously. However, we should remember about high global inflation that accompanied that has been into gains on the markets. So we can see that here with US equities, US bonds both going up, UK bonds and German equities really are the ones suffering. So the biggest victim of the conflict in that sense of the biggest damage done to a country was the one that suffered the most. Other countries really, unless there is some sort of an issue on their territory as well, did not suffer that much. World War II, World War One looked like a correction when compared. World War Two looked like a correction when compared to the turmoil of the 30s. So we had the Great Depression coming in at the end of the 20s. So the bull market followed a definitive victory of Allied forces as markets priced in the potential for a stability long term. Korean War also turned out to just be a correction, although the Korean War was really limited to that Southeastern Asia region and the US at that point. So it didn't really have any impact on mainland US or mainland Europe in that case. At the moment, though, the situation is a little bit different. We can see here the different Dow Jones, how it was reacting to several different major events in the war. We can see post-crash rally of the 1930s, German victories, Pearl Harbor, D-Day, and then past D-Day moving forward, and then past the war, we saw some consolidation. Capital market performance during times of war. We saw U.S. equities at times of conflict. Surprisingly, U.S. equities experienced higher rates of return and lower risk at times of conflict, probably in a sense because of the fact that riskier assets such as stocks, perhaps, or rather other assets, were seeing a little bit less demand. Vietnam War was an exception, but there was other reasons behind it as well. It shows that it is the initial uncertainty that is the worst for investors. So just like many other occasions we've seen with many other things, the initial uncertainty and the initial shock of whatever may be happening is really what impacts the markets the most in the past. Obviously, this is past performance and does not reflect future performance. So every time it could be different, things could change, but it is important to evaluate how things have evolved in the past, just to form an opinion and understand that markets, even worst case scenarios, sometimes can be priced in. So this can happen with anything really, in the sense that the bigger the disappointment or unexpected surprise in a positive sense, the more of a reaction, even if it is a positive or negative, it really doesn't matter at that point. So as I said, it shows that the initial uncertainty is the key thing to keep an eye on. Here we see war is inflation. Obviously, war brings in a lot of higher costs because it makes raw materials and everything else cheaper or more expensive and more difficult to acquire, especially, as I mentioned, due to the fact that in this very particular case of Russia, we have the oil market, the natural gas market, which then tends to reflect on everything else because it costs transportation, then shipping, and then so on and so forth. Also, we discussed in the video last week, which again you can find on YouTube, how Russia is actually very important for the platinum and palladium market as well, which are precious metals, but they're used for batteries and they're used for a lot of the electric vehicle technology that we are moving forward, chips as well, in addition to oil and, as I mentioned, natural gas. Also wheat, because as I mentioned, the regions that are being at the moment contested, and also Russia as a mainland is really a huge producer of wheat as well. So, and inflation means higher prices of commodities. We've been dealing with that excessively at this point. Wheat and hog prices, so food prices as well, increased the most during World War II. We saw that as uncertainty rose. Although World War II was a catastrophe for the continent, so huge bombings, complete destruction, and really 7-8 years of absolute uncertainty. Here we see times of conflict were good times for markets, but the main issue was accompanying inflation, which is obviously bad for the consumers. A bull market started after it was tamed. So we have to differentiate here between the markets and then consumers and everyday life, because yes, we can see the stock market go up and that may be a sign of good performance. But at the same time, if most people don't have any money to eat or to travel or to do anything, then eventually that catches up. It just is, in a sense, a bubble at that point. However, After the inflation is tamed, whether it be through central banks or whether it be through just stabilization of the situation, we see usually a tendency to uh, boom on the stock market as well. So, as I touched on earlier, Europe is really reliant and, in a sense, addicted to Russian energy until they move away from natural gas and oil, which is quite unlikely to happen in the very short term, at least. So, the problem is that those are limiting them from then implementing any sort of serious sanctions, because then they would backfire, as I mentioned at the beginning. So let's take a look at oil and the OWTI. Russia is the main supplier of energy to Europe, is a key producer and exporter of many commodities. Key issue for Europe is high dependency on Russian energy commodities, oil, natural gas, and coal. Simultaneously, Russia and Ukraine are not key partners in terms of exports. Energy security in Europe is the key in consideration with sanctions to levi on or what steps to take against Russia. So they're limited by that in a sense. You can see here how the EU trade with Russia by product group 2010 and 2020. See chemicals, energy, raw materials, food and drink, machinery and vehicles, other manufactured products, and other products in general. Russia is the key producer of energy commodities. Russia exports more than half of its energy commodity production. Over a third of Russian budget income is tied to exports of energy and commodities. So, again, very, very important for the Russian economy as well. So it would also hurt them to not export to Europe. At the same time, Europe would then have to deal with so much more as a result of this inflation that I talked about earlier. Majority is exported to European countries, but Asian markets are becoming more and more important as the biggest country in the world, they have access to Asian landmass as well. And you can see here the total energy production and consumption for coal, dry natural gas, and petroleum and other liquids. Russian oil exports. Europe is without a question a key market for Russia. Nevertheless, Asia is becoming more and more important. China, Japan, and South Korea. Russia exports around 5 to 6 million barrels per day. The amount sent from Russia to Europe isn't big. Return of Iran, US, and Norwegian oil are able to satisfy European demand. So we saw actually some moves from that and on negotiations with Iran for the Iran nuclear deal to then allow about 2 million barrels per day from Iran. We could see an increase of US exports to Europe, and also really an increase from Norwegian reserves, and also an increase we could see from the Middle East back into Europe if prices were to stabilize that way. However, oil market has been tight already, and Russia-Ukraine conflict is another factor that may encourage buyers in the sense that demand and supply are very, very close at this point, with a few limiting capacities being reached. JP Morgan forecasts $120 per barrel of oil, while Citi sees 10% price gains in case of conflict. So as you can see, there are some predictions. Compared to now, let's say JP Morgan would be a 20-30% increase, while Citi sees it about 10%. So you can see here, Russia crude oil and condensate exports by destination. Europe, Netherlands, Germany in particular, Poland, Finland, and others. Non-OECD countries, Belarus, Lithuania, which you saw on the map earlier. Belarus is exactly next to it. And actually, you can see here, China, Japan, and other are also becoming more and more reliant on Russian exports as well. Nat gas, which is another huge commodity for Russia. Europe's huge dependent on Russian gas. 40% goes to Germany, France 18, and Italy 20. Europe could become independent from Russia, but this would lead to a massive increase in prices. Prices would certainly rise to new highs and above 200 euros, which would encourage many exporters to ship gas to Europe. Europe could import more gas from Norway, the US, and Arab countries, the current share of which is very small. In contrast, the impact on nat gas is quite limited due to logistical constraints. And you can see here on this source, CNN, with this WTO, US Consensus Bureau, in Eurostat, a chart showing us the distribution of supply. Gold, so how gold has been reacting. Russia is a key player in the gold market as well, is the third largest gold producer in the world, which is an interesting fact. Russia is in 5th place in terms of gold reserves, about 2,300 tons, more than China and the entire Euro area. They have this tendency to have more gold. Gold in Russia's reserves account for only 22%, while the world's largest economies maintain the share of gold in reserves at even 50-60%. A further escalation of the conflict may lead to more gold purchases by the Bank of Russia, which has a tendency to buy gold and then store gold, as well as obviously the country producing it itself. You can see here the distribution of gold mine production in 2020. So, and we can see, therefore, a conflict would equal potentially more demand and less supply of gold. As I mentioned at the beginning, gold as a safe haven asset is becoming more and more interesting to investors. The attack on the World Trade Center and the invasion of Iraq increased the price of gold. So we saw that after September 11th here around this area. However, and then the invasion of Iraq. However, the massive uptrend and had many more factors accompanying it. The main one was the weakness of the dollar. So investors tend to see gold as a safe haven as well. Perhaps this factor will be felt in the period of economic slowdown as interest rates are adjusted and as central banks try to adjust for inflation as well, as we've discussed. And next month, there's going to be the Fed meeting, so it's going to be very interesting to see what happens in that end as well. Perhaps this factor will be felt in the period of economic slowdown. On the other hand, gold, unlike Bitcoin, react to geopolitics today in the opposite way to indices. So Bitcoin and maybe cryptos, but particularly Bitcoin, was reacting in the same way as a safe haven for a little bit, and it was being compared as, or called, the digital gold. Now, recently we've seen a little bit of a change in that aspect where gold is really reacting more like stocks, or sorry, I mean, Bitcoin is reacting more like stocks. So we've seen the Nasdaq have a downturn, and then cryptos have a downturn, and so on. So it's decoupling from the safe haven status, as we've seen, more of an actual risky investment that a lot of people are making at this point. So gold is actually still retaining its safe haven value in the eyes of many investors, and that is reflecting in the price potentially at the moment. Wheat, another commodity, key commodity that we discussed. Russia and Ukraine are also large producers of agricultural commodities. Russia is a significant producer and exporter of many raw materials like gas, oil, coal, wheat, corn, palladium, platinum, aluminum, and nickel. From less known commodities and goods, we have sunflower, rapeseed, oils from these products are also also fertilizers. So you can see very, very big variety of important raw materials and commodities that are exported and produced by Russia and the Ukraine as a subset. Russia is a significant producer of fertilizers. Without Russian fertilizers in Asia and Europe, crops could be lower and prices could rise even more. So you can see how this situation really encompasses every aspect of the economy in a sense, both with inflation being tied to the energy prices, but also to inflation being tied to the actual supply of these commodities themselves, which are really produced a lot by these countries as well. Russia is the largest single exporter of wheat. With Ukraine, they account for about 30% of global exports. The price of wheat may rise to an all-time high should both countries suffer the supply problems as they would be unable to then export. So you can see here, top 10 countries for wheat.world my exports. You can see European Union, Russia, Australia, Ukraine, United States, Canada, Argentina, Kazakhstan, and Turkey and India. And the distribution is quite even, but we see obviously Russia accounting for about 17.1%, when the whole European Union is about 18.3%. Russian stocks now, the ones that have been suffering a lot at the point, dominance of energy companies. The strong correlation of the Russian RTS index with the oil prices is due to the specific composition of the index itself. Energy companies account for about 40% of the whole index, which is why, as I mentioned at the beginning, it's interesting that it's dropping so much when oil prices are actually going up. The mining and financial sector together account for another 40%. And the largest companies in the RTS index, you may have heard of these ones, or at least some of them. Gazprom, 15.9%. Lukoil, 12.6%, Sberbank, Norilsk Nickel, and Yandex, about 12, 6.6, and 6% respectively. You can see here the distribution by sector, with energy about 40%, financial 20%, metals and mining 18.5%, and IT about 9.9%, and then a small section here, telecommunications and consumer. So we have some Russian companies worth paying attention to with their weight in the index themselves, with a total of about 73.87%. Gazprom, the new sanctions could also apply to Nord Stream 2. We saw some Germany halting that potentially, which is the new flagship gas pipeline from Russia into Europe, going through Ukraine, if I'm not mistaken. It is possible that the current situation is an attempt by Moscow to force concessions of the issue of Nord Stream 2. Lukoil, a company responsible for approximately 2% of the world's oil production, the US imposed a sanction on the company regarding new production projects in the Arctic zone and deepwater drilling. Now, they may have several reasons for that. Sberbank, Russia's largest bank and one of the largest companies in the RTS index. We can see it here, about 12.6% in the weighting of the index. Sanctions on the sector, such as a ban on access to the international settlement system, may be among the first to be taken by the West. Norilsk Nickel, the world's largest producer of nickel and palladium, and one of the largest producers of platinum. These three metals are expected to play a key role in the transformation of electric vehicles. So you can see how it's tied to also the gas. So on one end, we have gas being really important and then contributing a large amount to that export. And then on the other hand, the alternative gas then and oil for transportation, they also contribute a very large amount too. Novatek, the second largest gas producer in Russia, and after Gazprom, the imposition of effective sanctions is hampered by the fact that French Total holds a large stake in the company, about over 15%. So many intertwined stories here happening where different companies own different shares in each other, and they're really limiting the potential for any sort of serious action. Some more news on these companies as well. Gazprom is trading at the largest discount compared to its rivals in the sense that it's dropped the most since from its high. The company's current valuation is only half the book value. Lukoil seems to be avoiding negative sentiment towards Russian companies. The company is valued similar to its rivals, both in terms of profit, sales, and book value. Sberbank has already lost over 10% this year. The company may be one of the first to be affected by possible sanctions. Now, that might be limited in the sense that how much then that would impact European or other markets. Sanctions on the financial sector can be imposed more quickly, and their impact is not as uncertain as sanctions on the energy sector. Norilsk Nickel is valued lower than its rivals. However, as history shows, sanctions on this company may be limited to its scale production, because it would hamper and hinder really all this production moving into the energy sector and electric vehicles that we are seeing throughout Europe. Sanctions on Rusal from 2018 do not work. The US withdrew due to the negative impact of sanctions on the aluminum market, especially its availability to the EU and other partners. Despite the decline in the share price by more than 12%, Novatek is valued at a similar level as its rivals. A sanction on the company seems unlikely due to the shares of the French Total. And you can see here the year-to-date returns with current PE, price to share, price to sales, and price to book value. So let's watch out for inflation. Again, a key topic that we've discussed extensively at this point, because it is a real topic that is impacting the lives of everyday consumers. So war is the flywheel for inflation. While the apogee of geopolitical market tensions may be near, conflict is another problem for the global economy. High commodity prices will make it difficult to reduce inflation. Further logistical difficulties may also appear. So just as we are seeing an easing of the situation with the pandemic, COVID, governments moving into normalization, central banks raising interest rates, moving into normalizing fiscal and monetary policies to adjust for inflation, we could be seeing some real issues with actual supply, which then would convert into inflation, which is necessarily tied into it, because it would be higher prices of these goods, as for all the reasons we discussed. Here we have CPI inflation changes year on year. United States, Germany, Spain, Poland, and Czech Republic, as you can see, jumping up through 2021 after a slight decline and normalization between 2019 or 2009 and then 2020. In conclusion, markets do not like uncertainty. Investors reacted negatively to the violation of Ukraine's integrity just through rebel-controlled areas. As unfortunate as the situation is, geopolitics tends to have short-term effects on the markets, which then, as I mentioned at the beginning, are accounted for as well. Paradoxically, the impact of wars on global equities has not been historically negative, although that might be a different story this time. The conflict in Ukraine can have a big impact on the commodity markets, oil, gold, and wheat, as we discussed, because of the huge production, reliance, and dependence of Europe on these goods. Perhaps we are close to the apex of geopolitical uncertainty, and we could be seeing some more certainty moving forward. In the longer term, inflation and the associated monetary tightening are of greater concerns for markets. So Hopefully this video was useful. We tried to cover all the aspects of what's happening, the markets that are most impacted, what to keep an eye on. We'll keep you up to date. Obviously, stay tuned on the X station with the with this news. You can see more details on that. We have excellent coverage on the matters, and of course, if anything else happens, we'll be here. So thank you very much for watching. My name is Walid Koudmani, Chief Market Analyst for XTV. Good luck with your trading.